You sit on your charts every day, taking 10 to 15 trades, chasing every small move in EURUSD. Your win rate might be decent, but you are mentally exhausted, and let's be sincere, your account is not growing. But you don't need all day, and you definitely don't need multiple trades. You need one clear simple setup, one currency pair, one session, and 20 minutes of focused execution. In the next few minutes, you are going to be learning a simple 3-step box theory approach used during the Frankfurt Open, designed to target small but consistent move in EURUSD. This strategy I'm about to show you wins only 44% of the time. So yes, you are going to have more losing trades than winning trades. If you are not prepared for this psychologically, this strategy could ruin you. Not because it does not work, but because you would not be able to execute it. What changed everything for me was not learning how to win more. It was learning how to lose the right way. And by the end of this video, you are going to see how a strategy with 44% win rate still makes you a profitable trader. So without further ado, let's get right into the chart. The very first thing that you should know is that this strategy I'm about to show you depends heavily on time. So between 6:30 to 7:30, you should be done trading. So in order to make sure you don't get confused, you want to make sure to set your chart to UTC. You also want to consider converting 6:30 a.m. to 7:30 a.m. UTC to your particular time zone, so you know what time in your country you want to find a setup to execute this strategy. Now, this strategy that I'm about to show you is based on one principle, and that is that between midnight UTC to 6 a.m. UTC, the market is usually quieter, liquidity is thinner, and price tends to move in a range instead of trending aggressively. This price behavior is exactly what we are looking to take advantage of in this strategy. So every morning I open my charts to the EURUSD chart and the 5-minute time frame. And the reason why I use EURUSD is because I found that this strategy works well for EURUSD. It may also work for GBP/USD. However, I have used this strategy for EURUSD, and I would also suggest that you practice using EURUSD and make sure it's the 5 minutes time frame. And of course, make sure your time zone is in UTC. So once everything is set, I isolate the time between midnight to 6 a.m. UTC. So technically, I isolate the Asian session. I do this by taking the highest point of any 5 minutes candle for that period. And for this, I see that it is here. You see, this is the highest point between midnight and 6 a.m. UTC. And I also take the lowest point of any 5 minutes candle between midnight to 6 a.m. So for this, it's here. The next thing I want to do is to draw a box to connect the highest and the lowest point between midnight to 6 a.m. UTC. So I take my drawing tool and I connect the box between midnight to 6 a.m. So there you have it. So the next thing I want to do is to check that this box is accurate. So I'll quickly take this up a little. Yeah. This box represents where price was accepted during the Asian session. It is the area where sellers and buyers were at a balance. Now, this box needs to be accurate, and to confirm its accuracy, you can bring in the trading session indicator to see how well the box overlaps with the indicator. You can see clearly that the box I have drawn clearly overlaps with the Asian session when I bring in the trading session indicator. Now, part of the reasons why this box needs to be accurate is because if you get it wrong, your judgment as you move forward will be wrong. Everything we do going forward depends on this box. Every judgment we make will depend on what this box is telling us, and that's why we have to draw this box properly. So you want to pay attention while drawing the box. So I'll quickly remove this because I don't want to clutter my chart. Yes, so I have my box, and once I have my box, the next thing I want to do is to wait for my trading window. My trading window is between 6:30 a.m. UTC to 7:30 a.m. UTC. So even though my range comes from midnight to 6 a.m. UTC, I do not trade that session. I don't trade the Asian session. I wait till it's 6:30 before I enter a trade. So when it's 6:30, I can now enter a trade. So before 6:30, I do nothing, and after 7:30, I am done trading for the day. And this is because between 6:30 to 7:30, price often comes back to test the Asian range, and this test of the Asian range is what I am looking to take advantage of. Now I'm going to quickly remove this so that it does not clutter my chart. So once it is 6:30, the first thing I want to do is to check for where price is relative to the box. If price is at the top of the Asian range, I am interested. If price is around the bottom of the Asian range, I am also interested. But if I notice that price is somewhere in the middle of the box, so price is just inside the box, then I may want to sit out for that day and I will not trade for that day, because I'm looking out for price at the top or the bottom of the Asian range. Now the reason why I will not trade if price is at the middle is because the middle is where randomness lives. Risk is higher, stops are wider, and there's no edge. And for this reason, my focus is at the edge of the box. And if for any reason the edge of the box is wrong, if I have drawn this box wrongly, it means that every decision that I'm going to be making going forward will be wrong. So get the timing right, get the edge right, and everything left is execution. So once it's 6:30, I pay attention to the edge. And when I say the edge, what I mean is very clear. The top edge is the Asian high, the bottom edge is the Asian low. However, I allow a buffer. So when I say the edge, I mean when price is at the boundary of 5 pip beyond or within it. So for this example, this is my Asian high, and my 5 pip buffer is going to be somewhere around, say, here. If price is anywhere around my Asian high to my 5 pip buffer, anywhere around here, it means that I can take a trade. If price was closer to my Asian low, so this is my Asian low, my buffer is going to be somewhere around here. So if price is anywhere around this Asian low and to this 5 pip buffer, it means I can enter a trade. However, if price is at the middle or inside the box, no trade. And if I notice that price has broken out of my 5 pip buffer, it means that price has turned my Asian low and Asian high to support and resistance, and that's now a breakout. That's no longer this strategy. So there will be a different strategy for that. But for this strategy, I only trade if price is around the boundary and then I give a 5 pip buffer. Now the reason why I stick to the boundaries of 5 pip within it is because either price defends the boundary or price breaks out of the boundary and turns our Asian high and low to support or resistance. So it is easier to make a decision here. The risk is lower. That is why I stick to price being at the boundary, and I will never take a trade if I notice that price is inside the box, at the middle of the box. So yes, my rules are very simple. I draw a correct box. I only trade within my trading window between 6:30 a.m. UTC to 7:30 a.m. UTC, and I only trade when price is around the boundary of 5 pip within the boundary. So if price is at the middle, no trade for me. If these 3 things are not present, I do nothing. These steps eliminate most of the trades. So as long as I'm looking out for these 3 things, there are days when I will not enter a trade, and that is very intentional, because the goal for this strategy is not to trade more, but to trade less with structure. If you can respect the time and wait for price to get to the edges, you've done the hardest part of the job. Now once it's 6:30 and price comes to the edge of the Asian range, I pay attention, not to enter a trade yet, but to wait. I do not enter a trade because I notice that price got to the edge of the Asian range. No, I wait for confirmation. I want you to pay keen attention here as I explain how to get confirmation for this strategy, because this is where most traders get it wrong. And if you get this step wrong, then your stop loss is most likely going to be wrong and your take profits will be wrong as well. So you want to pay attention. In this strategy, note that trigger is not a single candle, it's a sequence. So I'm going to highlight the sequence of candles that form as price gets to the boundary. The first candle breaks outside the box. This candle is not our entry point, but it tells us that something has changed. Remember that during the Asian session, price often moved in a range, and we are seeing a candle that has broken out of that range. So it tells us that something has changed. Now, right after the breakout candle, you will see an opposite candle. If price is around the top edge of the Asian range, your breakout candle is more likely to be a bullish candle. And so the next candle that forms after it will be a bearish candle. On the other hand, if you notice that price is at the bottom of the Asian range, your breakout candle is most likely going to be a bearish candle, and the next candle that forms after it will be a bullish candle. We will see that when we see a buy trade example. But for this, we see our breakout candle is bullish and the next candle forming is bearish. Now, this second candle is called the trigger candle, but we don't enter yet. However, this candle is very important. This trigger candle will be used to define our risks and to place our stop loss as we move forward. After the trigger candle forms, we wait for one more candle to form, and that candle will be our confirmation. The next candle that forms will also be in the same direction as the trigger candle. And as you can see, the next candle that forms on our example is also a bearish candle. And since this is a sell trade, because price is around the top edge of the Asian range, meaning that we are expecting price to reverse. Since it's at the top edge of the Asian range, price is to reverse downward. And the next candle that forms is a bearish candle. So that confirms that price is going down, and that is our signal to enter. Now, you want to keep in mind that there are days when price will not break out of the Asian range, but you would notice that price is either around the top or the bottom of the Asian range and is just touching the boundary. On such days, you want to quickly check a correlated pair. Now, since I am trading EURUSD, I'm going to check GBP USD. If GBP USD broke out, that tells me that the move is real, and so I can now comfortably go ahead to execute my trade on EURUSD. But if GBP USD does not break out, that's makes me uncomfortable. The move may not be real, so I'll just sit out and I will not trade for that day. This helps me avoid false moves and bad timing. So this is my confirmation candle, and I'm going to enter at the close of this candle. So let's mark that point. So this is where I'll enter the trade, here at this point. Now, once I have identified my entry point, the next thing I want to do is to set my stop loss. And for my stop loss, the rule is very simple. For a sell trade, my stop loss goes 3 pip above the high of my trigger candle. Now, this is why I said the trigger candle is very important. Now, for a buy trade, my stop loss goes 3 pip below the low of the trigger candle. So yes, my trigger candle determines my risks, not me. I do not place my stop loss around round numbers or move my stop loss to safe areas. My trigger candle makes that decision, and this eliminates the need for me to make a decision based on emotion. I just use math. So this is the high of my trigger candle. My stop loss is going to be somewhere around here for this example, 3 pips above the high of my trigger candle. So once my stop loss is set, my take profit is calculated immediately. So just like I took my stop loss, for my take profit, I also allow the rule. I allow math guide me. Now there are 2 cases. So for the first case, if my stop loss is 8 pip or less from my entry, my take profit will be 11 pip. No adjustment. Every small trade has the same target, 11 pip, as long as my stop loss is 8 pip or less from my entry. This keeps my reward larger than my risks, even when I am wrong more often than I am right. And then case 2, if my stop loss is greater than 8 pip from my entry, my take profit scales proportionally. The formula is simple. So I take the distance between my stop loss and my entry, I divide it by 8, then I multiply it by 11. This gives me my take profit. So if the distance between my stop loss and entry is 10 pip, my take profit will be 13.75 pip. If the distance between my stop loss and entry is 12 pip, my take profit will be 16.5 pip. And if the distance between my stop loss and entry is 16 pips, then my take profit will be 22 pips. This keeps the same risk to reward ratio on every trade regardless of candle size, and this consistency is critical. So for our example, I set my take profit around here. Now in this example, the distance between our entry point and our stop loss is 11 pips. So for this, we have to use the formula. Take the distance, divide it by 8, then multiply by 11. And that's how we get our take profits. So our take profit will be somewhere around here. Now once I enter a trade, my job is done. But at this point, there are 3 possible outcomes. First, price may hit my stop loss. And if it does that, I count my loss. I've lost for the day. I close the trade and I may sub, but I'm done for the day. Now the next possible outcome is that by 7:30, price is yet to hit my take profit. And that is the outcome in this example. This is our take profit here, and this is 7:30. You notice that price is yet to hit the take profit. And if this happens, by 7:30, I close my position, take my profit, whatever it is, and I'm done for the day. I try not to get greedy. Now, the third thing that can happen is that price hits my take profit, which is what I wish to happen, of course. And if this happens, I count my wins, I close my trade, and I'm done for the day. Now, if you look at this example, if you had held the position a little longer, say maybe till 7:40, price would have hit your take profit. However, if you had left it much more longer, you would see that price will start eating into your profit, and at that point you will notice that you begin to make emotional decisions because you made profit and now you are seeing this profit being wiped off. You may become emotional, even though later price still surpassed the take profit. So you want to stay to 7:30. By 7:30, you close your position and you go. Now let's see another sell example, so we are sure that we've understood what we've done so far. So on this day, I come to the chart and I mark the highest point and the lowest points between 12 midnight and 6 a.m. So this is the highest point. Yeah. And then this is the lowest point. After that, I connect both points using a box. Yes. Then I also want to bring in my trading session indicator just to confirm. So you see that my box overlaps the indicator properly. I take this out to declutter my chart. I don't want my chart to have too many lines because then it can become confusing. So I have my Asian range. This is my Asian range here. Now the next thing I want to do is to observe what price does when it comes to 6:30. And this is 6:30. I notice that price is still inside the box, so I want to wait. So sometime around 7:10, I have my breakout candle. You can see it here, but I do not enter yet. It just means that something has changed. The next candle that forms my trigger candle in the opposite direction of the breakout candle. My breakout candle was a bullish candle and this is a bearish candle. The next candle that forms closes away from the boundary, and so this is my trigger candle. So I enter at the close of my trigger candle. So I enter here. So I'll quickly take out the circle so it does not become cluttered. Now this is the high of my trigger candle. I'm going to place my stop loss 3 pips away from the high of my trigger candle. So there you have it. My stop loss is going to be here. So after that, I want to set my take profit. Now the distance between my entry and my stop loss is around 7.2. So what that tells me is that my take profit is going to be 11 pip because the distance between my stop loss and entry is less than 8 pip. So my take profit is going to be somewhere around here. So there you have it. I've identified my entry, my stop loss, and my take profit. You notice on this day, if I hold the position till 7:35, my take profit is going to be triggered. However, if I want to be conservative like I always try to do, by 7:30 I take my profits and I close the trade. Now something to keep in mind is that your breakout candle, trigger candle, and confirmation candle, they may not show up on time. For example, on this day my breakout candle showed up by 7:10 and my trading window is between 6:30 to 7:30. So on those days I know that I may not get as much profit as I'm looking to get if I close my position by 7:30. So let's see another example, but this time around a buy example, so we can understand how this strategy works both ways. So on this day, I identified the highest point and the lowest point between midnight till 6 a.m. and then I draw a box to connect those points. So my box starts by midnight. Please note that I do not just draw a random box to connect. The box starts by midnight and ends by 6 a.m. You want to cross check that your box is accurate, so you want to overlap the Asian range. So you see how it overlaps. Now the next thing I want to do is to see what price does when it's 6:30. So at around 6:35, I see that price has properly broken out of the Asian range with a bearish candle. So this is my breakout candle by 6:25 here. Now after my breakout candle, I see my trigger candle. My breakout candle was bearish and you see that my trigger candle is bullish. So by 6:40, I see my trigger candle, but I do not enter the market yet. Now by 6:45, I finally see my confirmation candle. Now because price is at the bottom of the Asian range, I can see that my confirmation candle is reversing. My confirmation candle shows that price is now reversing upward. So I want to enter at the close of my confirmation candle. I'll quickly take out this circle so that it does not clutter my charts and cause confusion. So I'll take it out. I only used it to highlight. So it's a long position. So this is where I'm going to enter the market. Here. Now this is the low of my trigger candle. I'll be setting my stop loss 3 pip below it. So my stop loss is going to be somewhere around here. 3 pip below the low of my trigger candle. Now the distance between my entry and my stop loss is 5.2 pip. It is below 8 pip. So my take profit, I'll be targeting 11 pip for my take profits going by the formula. So my take profit is going to be somewhere around here. There you have it. My stop loss, my take profits, and my entry. On this day, if you notice, even before 7:30, like around 7:25, my take profits will be triggered. So I take my profits and I close my trade and I'm satisfied for the day. Now here's a simple way to help you identify your stop loss and your take profits once you've identified your entry point and your trigger candle. You can use any large language model for this. For me, I'll be using ChatGPT. Now what I'll do is to enter my rules to ChatGPT, so it locks it in and it knows that these are my trading rules. Now once I've identified my entry and my trigger candles low or high, I've entered this on ChatGPT and I ask ChatGPT to tell me where my stop loss and my take profit will be based on my rules, and it quickly identifies it for me and I enter it into my trading platform and I do not waste time calculating. Very easy and straight to the point. I hope you found that helpful. So yes, now you know how to execute this strategy. Let me show you my equity curve. Now this is my equity curve. Every point on this curve comes from executing this exact strategy. When most people look at this curve, what they will see is that it is moving upward, but that should not be the focus. I want you to observe that there are times when I experience pullbacks, because these pullbacks you see here represent losing streaks. They represent days where I lost, and that is why I say this strategy has only a 44% win rate. Initially, on days where I experienced pullbacks, I felt bad. I felt, oh my god, what did I do wrong? What do I need to correct? But then I grew to realize that these pullbacks are normal. It is the design. If I'm looking for a 100% win rate, then I'm looking to be cheated. If I look out for those who sell signals and say, oh, it's a 100% win rate, then I know I'm going to be cheated. Real professionals know that there's no strategy that wins all the time. What you want to make sure is that your win trades are able to cover for your losses and still give you profit. And that is what this strategy does. Your realistic expectation after 20 trades is that you are going to lose 11 trades and win only 9 trades. If you win 9 trades and the average pip per win is 10 pips, it means that you've gotten 90 pips. Now if you lose 11 trades and the average loss is 6 pip, it means you've lost 66 pip. Now you see that your net result is 24 pips. Despite losing 55% of the time, you are still in profit. This is not luck, this is the design. The essence of this video is not to prove to you that this strategy works. It works, I know. You can already see it from my equity curve. The essence of this video is to prove that you too can execute this strategy. This is why I would like to invite you to a 20-day trading challenge where we use only this strategy every morning until where it takes us. If you'd like to be a part of the 20-day challenge, visit mytradingland.com and join my community. It is absolutely free of charge. You don't need to pay any amount of money. Just visit mytradingland.com and join. So I hope to see you at mytradingland.com. I also hope you found this video helpful, and if you did, please subscribe and of course give this video a thumbs up and let's know how helpful this video was to you in the comment section. Thank you. Bye bye.